Alright, welcome back to class. Let's pick up from where we stopped in our previous class. We'll be looking at sections 11 and 12. Okay, so here we just had to quickly explain, here we said sections 11 and 12. It's meant to be an introduction to IFRS for SME in respect of financial instruments. So section 11 and 12 together was one that dealt with recognizing, measuring, disclosing of financial instrument, talking about financial asset and financial liability. So now let's break it down in proper. Let's look at section 11 is the one that talks about application of basic financial it's looking at how we can apply certain rules to the basic financial instruments, and it is relevant to all entities. All entities. Are we making any sense? Quote me, all entities. While section 12 applies to other more complex financial instruments and transactions. You get? So an entity must either apply the provisions of both section 11 and 12 in full. Do you get? So you have to consider if an SME wants to consider any of this, is that it considers the provisions of both section 11 and 12 in full, or the recognition and measurement provisions of IFRS 9. Do you get? Recognition and measurement provisions in IFRS 9. So let's quickly look at the basic financial instruments. That's the one in the section 11. Now this section applies to all entities, like I said earlier. So a financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. You know this now, IAS 32, so it should not be a problem to you. And that entity must recognize a financial asset or a financial liability. Remember the recognition criteria. On initial recognition, an entity must recognize a financial asset or financial liability only when the entity does what? Becomes a party to the contractual provision of the instrument. So when you become a party to the contractual provision of the instrument, you must immediately recognize financial instruments, or you must recognize a financial asset or liability. Are we making any sense at all? So we've considered the initial recognition. Do you get? So let's look at measurement also. Measurement of financial asset and liability on initial recognition is at the transaction price, that is including transaction costs. But we have some particular exceptions to this, and I believe these are things that we have done. Do you get? It's still kind of following what we have done in IFRS 9, and I was mixing IFRS 9, IFRS 32 and thereabout. I'm sorry, IFRS 9 and IAS 39, IAS 32, do you get, an IFRS 7. Now please, when you have financial asset and liability that are measured at fair value through profit or loss, do you get? When you have them, they are measured at fair value through profit or loss. Please do not capitalize transaction cost or issue cost. It is expense to the profit or loss. That's just one of the exceptions. Then if you have financial transactions with the sale of goods, or in connection with the sale of goods, and in a situation whereby the payment is deferred beyond normal business terms, or is financed at a rate of interest that is not a market rate, what we are just trying to say is that if you have a particular financial liability, do you get? So where the financial asset or the financial liability is measured at the present value of the future payments, do you get? So if you are having maybe you have financing transactions in connection with the sale of goods, if payment is deferred beyond normal business terms, or is financed at a rate of interest that is not a market rate, where the assets or financial liability is measured at the present value of the future payment. So please, you are not going to be capitalizing transaction cost there. So what about subsequent measurement at the end of each reporting period? We've we've considered initial measurement. For debt instruments that are measured at amortized cost using the effective interest method, so debt instruments, you usually use the amortized cost, isn't it? It's more like what we have done in IFRS 9. But there are some exemptions for debt instruments that are classified as current assets or current liability, which should be measured at an undiscounted amount. Do you get? That's what you should use to measure it. And another exception is if an arrangement constitutes a financing transaction. So the debt instrument is measured at the present value of the future payment. And lastly, investments in shares must be measured at fair value with all gains and losses recognized through profit or loss. So that's that for subsequent measurement. So we've considered recognition and we've considered the initial recognition, measurement, and subsequent measurement. Now let's look at what section 12 is saying. This section applies to only those entities which have complex financial instruments. So this includes derivative and any instruments with an embedded derivative. So an entity must recognize a financial asset, talking about the initial recognition, must recognize a financial asset or financial liability only when the entity becomes a part or a party to the contractual provisions of the instrument. Now, when a financial asset or financial liability is recognized, an entity must measure it at its fair value. That's usually the transaction price. And at the end of each reporting period, an entity must measure all financial instruments within the scope of section 12 at fair value and recognize changes in the fair value in profit or loss. Did you get what we said there? So at end of every reporting period, the entity must actually measure all its financial instruments, including financial assets and liabilities. And what they will do is they will now, within the scope of IFRS 12, at fair value and recognize changes in the fair value in profit or loss. And this section includes a simplified hedge accounting regime, which can only be used to account for hedges of the following risk, like interest rate risk, foreign exchange interest rate risk. We have price risk of commodity that is held or in a firm commitment or highly probable forecast transaction to purchase or sell a particular commodity. And we also have foreign exchange risk in a net investment in a foreign operation. And that's that about that. Now let's look at section 13, talking about inventories. For this section 13, there are no significant differences between the IFRS for SMEs rules on accounting for inventory and those found in IAS 2. So you can use IAS 2 also. SMEs can use IAS 2. Now section 14, this particular section also has identical rules. Do you get? It is investment in associate. So the rules on identifying investment in associate are very similar to those found in IAS 28. That's the full IFRS that is treating this. So similar to those found in IAS 28. Now, please don't forget that section 14 allows an entity to account for all its associates using one of the following. One, it can account for it using the cost model. It can use equity model. Lastly, it can also use fair value model. Whichever it deems it fits to use, it can use fair value model. And lastly, let's look at section 15. Section 15. Section 15 first of all defined a joint venture. Then it now also defined joint control. Section 15 is talking about investment in joint venture. You still remember IFRS 11? That's the equivalent in. The reason why I'm just making reference to it is for us to. I know you know IFRS, full IFRS very well. So let's make reference to it so it can aid your understanding. Now, what IFRS for SME defined a joint venture as a contractual arrangement whereby two or more parties undertake an economic activity. It's very important. Or a commercial activity. It has a commercial substance. Economic activity that is subject to joint control. So you guys are coming together just to set up an economic entity that is still subject to joint control. So you guys are having joint control. It's not one person. You get it's not a sole proprietorship. Now, joint control, what do we mean by joint control? Joint control is the contractually agreed sharing of control over an economic entity. How do we intend to share control? Who is having more control? Who is this? Do you get in the sharing formula also? Who can influence financial decisions and all of that? So that's what we mean by joint control. Now, the IFRS for SMEs identifies three broad types of joint venture. They said the jointly controlled operation, jointly controlled assets, and lastly, jointly controlled entity. Now, let's look at the jointly controlled operations. The joint control only exists when the strategic, financial, and operating decisions relating to the economic activity require unanimous consent of the entities sharing control. Do you get? So joint control is the key factor in deciding whether a joint venture exists. Do you get? So if you want to know if a joint, sorry, I'm still explaining joint control. If we still look at joint controlled operation, don't worry, but I just want to be clear of that joint control very well before I proceed. So a joint control is just the major key factor in deciding whether a joint venture exists. Do you get? So the characteristics, certain characteristics are common to all types of joint venture. One, you see that it involves two or more joint venturers who are bound by contractual arrangements, and it's usually in writing, and it's also a contractual arrangement establishing joint control. Now let's talk about a jointly controlled operation. An entity with a jointly controlled operation recognizes the assets that it controls and the liability that it incurs. So if you are in a jointly controlled operation, if you are part of the entity there, you must recognize the assets that it controls, that you yourself is controlling, and the liabilities that you incur. And you also have to recognize the expenses that you incur and the share of the income that you earn from the sale of goods or services by the joint venture. Now, an entity with an interest in jointly controlled asset, now that's what I want to look at. What must they recognize? They must recognize, one, that share of the jointly controlled asset are classified according to the nature of the asset. Some people can come together, put money, get an asset, and be using it. You get, and they'll be using it to make fun. So it seems like a jointly controlled asset. Do you get? So an entity with an interest in jointly controlled assets must recognize the following: one, its share of jointly controlled assets classified according to the nature of the asset and any liability that it has incurred. Then it must also recognize its share of any liability incurred jointly with other venturers in relation to the joint venture. Then any income from the sale or use of its share. The thing here is that when you have a jointly controlled operation, you will have assets that belong to everybody. Do you get? So that's just the trick there. Are we making any sense? Sorry. In a jointly controlled operations, I'm just giving you like a tip now. You can have assets there that you guys jointly control. So you should also recognize an income from the sale or use of its share of the output of joint venture, together with its share of any expenses that have been incurred by the joint venture. And lastly, we recognize any expenses that it has incurred in respect of its interest in the joint venture. And lastly, an entity with an interest in jointly controlled entity, an entity with an interest in jointly controlled entity must account for all of its jointly controlled entities using one of the following. It can use the cost method. We are usually familiar with the equity method though. Cost method model, it can use the equity method, or it can also use fair value model just to account for its interest in the jointly controlled entity. You understand this better now. You have done it before, so there's no need to waste much time on that. Now, talking about section 16, this particular section 16, I'm not referring to 14 now. How come am I? Okay. Oh. You know, we are just making reference to section 14. The section 14 rules on identifying investment property are very similar to those found in IAS 40. right? And section 14 requires that investment property must be measured. Sorry, section 16 rather. Section 16 requires that the investment property must be measured at fair value. That is, cost model is not allowed. Please note that cost model is not allowed. That fair value, cost model. So I'm moving this, is not allowed. Of course, you know there should be exceptions to this, isn't it? Unless the only way you can use cost models, unless fair value cannot be measured reliably without undue cost or effort. So that is when you have to state reasons for this. That is when you might not be able to apply fair value to this instead of cost model, or measured at fair value. Let's also look at section 17, talking about property, plant and equipment. This section applies to accounting for property, plant and equipment and investment property whose fair value cannot be measured reliably without undue costs or efforts. Most of the section 17 rules are similar to those in IFRS 16. However, you know, there are some differences. For example, residual value, useful life and depreciation needs to be reviewed only if there is an indication that they may have changed since the most recent annual reporting date. You see, this one does not require an annual review like the IFRS 16 that requires an annual review. This one is just when there's indicator, or there's an indication that all of these things would have changed, do you get, since that most recent annual reporting date. Now let's look at section 18, intangible assets, right? Section 18, intangible assets other than goodwill. Now, section 18 rules on accounting for intangible assets are also familiar to the IAS 38 rule. You know, it's IAS 38 that actually dealt with intangible assets in the full IFRS. But there are some differences. They have stated it here. All assets within the scope of this section must be measured. Subsequently, using the cost model, and revaluation model is not allowed. You see, so we say revaluation is not allowed. That's one of the exceptions. All research and development costs must be expensed as incurred. So when you are incurring any research and development costs, you must expense it according to IFRS SMEs, that's section 18. And lastly, there is no capitalization of internally generated intangible assets. So you should not capitalize internally generated. You don't have control over it now. If you go back to IAS 38, you still see things like this there. Now, please note that all intangible assets must be amortized over their estimated useful life. So please, if it cannot be estimated, or you cannot estimate a useful life of 10 years is assumed. Do you get? So if you cannot estimate it, then a useful life of 10 years is assumed. And this actually means that there is no requirement to test unamortized intangible for impairments on an annual basis, just like the one in IAS 38. Alright, let's quickly look at section 19, business combination and goodwill. Yeah, this section, IAS 19, section 19 rather. This section 19 rules on accounting for business combinations and goodwill are similar to IFRS 3 rules, but we said that there are some differences. One, acquisition costs are capitalized under the standard, whereas they must be expensed under IFRS 3. You know, we used to expense the acquisition costs, but they said here we must capitalize it. So, and lastly, goodwill is amortized over its estimated useful life. But in a situation whereby you cannot estimate a useful life for goodwill, then you can make use of a useful life of 10 years. Just assume it. That's what the standard, the section says. And this actually means that there is no requirement to test goodwill for payment on an annual basis. Alright, that being said, let's bring this class to an end for today so that we can have time to revise on all what we have done. So when next we'll be meeting, we'll continue from IAS 20. So thank you and stay safe. Be fine.